maybe confirm some of the patterns that we saw earlier, if those analogs remain. Don't know, but that certainly is possible short run. Longer run, I'm less optimistic. This is obviously a market very responsive to news, and news about government rescues could certainly precipitate dramatic rallies, as it did today. I mean, the rescue of, or the proposed addition to the EFSF, the rescue fund in Europe. We could get, they've got a series of these things. We've almost seen like two rumors a week come out of the European discussions, one every weekend and then another one in the middle of the week. So it's been, and most of them have been pretty good for giving the market a little bounce, even though right now nobody's really putting up any money. This whole EFSF is pledges. And now they're going to make the pledges $2 trillion. But somebody ultimately has to put up money if you're going to bail some of these entities out. And is it all going to come from France and Germany? I heard late in the day talk about, well, France and Germany's they're trying to get away from having any responsibility for helping to fund the non-French German banks. They only want to kind of ring-fence their own banks. Well, that's going to leave an awful lot of banks out there in need of somebody else stepping up to the table with some money. This is a very fluid situation in Europe, I suspect. So those of you who do a lot of your investing on your own, I wouldn't put more in stocks than you have the potential and the ability to withstand some significant losses if they should occur. They may not occur. Maybe governments will win. Maybe they'll provide the answer. They'll flood enough money into the system that all kinds of asset prices will rise. That will cause other kinds of dislocations, but it certainly could push prices up. That's not normally the way it works, but that could happen. That's one of the positive outcomes from an equity perspective, though there would be dislocations elsewhere. Let me make a couple of comments just on bonds before we close. If you look at the next page, this is the long-term graph that I like to keep people updated on. This is the 10-year U.S. Treasury interest rate. This isn't bond prices. This is interest rates on the U.S. 10-year, which from the beginning of the 1980s up here, up in the mid to upper teens, has come down all the way to 1.72 just a couple of weeks ago or so. And that's with a little government help, obviously. This has been about the most successful of the financial assets that one could have been in that time period. It could still be productive if we go into a recessionary period, or if the government is successful in Operation Twist, keeping the long-term interest rates like this down low. The danger, of course, is what you can see in a very short form just in the last couple of weeks. If you just happen to be the unlucky buyer who bought 1.72 down here, you've lost 5% in the first 2 weeks or so of your proud ownership of those securities. And it's when you have virtually no coupon to offset capital changes, you better not see interest rates rise too fast. If you look over at the next page, you'll see this is just a blow up of the last 5 years or so. Same bond, it's the 10-year Treasury yield. And here we were down at a couple of weeks ago here at 1.72. I think it closed today at 2.15, 2.15. It bounced around a lot in response to the news. And we just Susan did some quick figures for me on some of these things. You see how quick, I mean, you look at the time. This is 1 year here. It's come down from about 375 to 172 down here. Well, if in the next year it went up from 172, now we're computing it from down in here at 212, 215, but if it went up to 375 in 1 year, even after you've received your income, you would lose 11% of your premium, of your capital. Your total return would be a minus 11%. So you're guaranteed, if you hold it to maturity, if you buy it here, say at 215, you're going to get 2.15% per year. You don't know what that'll buy 10 years from now, but you'll get 2.15%. But, of course, if they flood the market with money and if interest rates go up into the teens and inflation is leading interest rates up, you won't be able to buy an awful lot with that. But right now, let's just say, if it went back to where it was a year ago, and certainly the Treasury is saying they're not going to let that happen, the Federal Reserve is saying that, excuse me, you'd have a minus 11% return for the year. If you went in 2 years, which is about where this one is at 4%, in 2 years, even after you'd have gotten your income, you would be out 10% 2 years after you made that purchase if it went to the 4. And then if it went up here in 4 years, up to the 5 1/4 area, even after you get your income, you would still be out 4 years into the ownership of a 10-year bond. You would still be down 10%. And of course, if inflation has gone up, your purchasing power would be significantly diminished. So if the world economy stays weak and central banks don't flood the world with paper money, high-quality bonds could still provide a good return, but obviously there are lots of risks. And the risk of being wrong, a point we've made now for some time, I could make a strong argument for interest rates going up or down. It depends on a number of variables. But as we look at bonds in this environment, and I'm talking about high quality bonds, not high-risk bonds. High-risk bonds are a whole different analysis. But in all likelihood, our view is that there is more risk in being wrong, i.e. interest rates rising, than there is reward if you're right and interest rates stay flat or even go down. So it's a very high-risk environment, even though it's been the most successful of the financial trades now over the last few years. Last point is slightly unrelated to all of the others, but I saw this the other day and I thought, wow, kind of an interesting thing. Excellent bubble indicator. This is Sotheby's individual stock over a period from the end of the 80s to present. And this is Sotheby's, obviously a company that's identified with wealth and prosperity and high-end auction house and so on. It has the interesting stock symbol of BID, which I thought that kind of appropriate. But you look here at these, it has spiked in each of the prior 3 bubbles. The Japanese bubble, the tech bubble, and then the housing bubble. We don't know what this is. Some people, they're speculating here it's an emerging market bubble. And, you can make that case maybe. But in any case, in each instance, in a period of some affluence and positive mood, Sotheby's screamed upward, only to collapse afterwards and keep screaming back up again when sentiment rises. How this will work out this time, really don't know. I think I'm getting a sign that it's dinner time or hors d'oeuvre time. Thank you. I'll be happy to chat with you afterwards.